I'm Mickey Fulp, the mercenary geologist. You can find me at contact@mercenarygeologist.com. That's also the website. Twitter at mercenarygeo. 55,500 Twitter followers. We're going to talk about vanadium today. I have a distinguished panel of CEOs. First off is George Glasier, CEO of Western Uranium and Vanadium. Gerald Panneton, CEO of Prophecy Development. Paul Cowley, CEO of First Vanadium. And Mark Charlmers, CEO of Energy Fuels. Nothing I say here today can be construed as an offer to go long or short, buy or sell any financial instrument. Gentlemen, this is what you're faced with. This is courtesy of Prophecy Development, and you see vanadium for 38 years and the price spikes. And so part of what we will talk about after each CEO gives a 2-minute rundown on his company is why is it different now? We'll start with George of Western Uranium and Vanadium.
Thanks, Mickey. Western Uranium, Vanadium, we just changed the name last year to emphasize the vanadium. We've got prior producing mines that were developed back in the 70s and 80s by Union Carbide. Union Carbide was a major vanadium producer in those days, as I think all of you at the table know, because we all have projects that Union Carbide was involved in. We've got some of the mines that Carbide actually produced. Sunday Mine Complex is a permitted mine. It's 5 mines in western Colorado. Very, very high-grade vanadium, probably mines at about 2%. We actually took a sample, and I've got that on my website. It showed a 12% sample of vanadium in that mine. The interesting thing about it, Union Carbide was both a uranium and a vanadium miner back in the 80s. And if the vanadium grade was high, but the uranium grade was low, they just left it in the mine. And I think Mark's got the same kind of situations in his mines where he's looking at the valuable resource of vanadium that was left in the mine simply because vanadium in those days was probably less than 50 cents a pound and uranium was $40 a pound. So the economics didn't lend itself to recovering that high-grade vanadium. So that'll be our emphasis to first go after that, and beyond that, certainly our uranium resource.
Well, that was quick. I gave you 2 minutes, you used about 1, so.
You're in a hurry.
Okay.
Good morning, everyone. Prophecy owns the Gibellini deposit. It's a Nevada heap leach operation. We're currently in the updating of a feasibility study that was completed by American Vanadium. For those who have been involved, Gibellini has been known for many, many years. It's an oxide deposit. It's actually not an open pit, but an open hill that we're going to be mining. Our strip ratio is 0.2 to 1. Metallurgy, all the work has been done to produce approximately 5,000 ton of vanadium V2O5 per year, or 2,500 V. And we're planning to continue our process of permitting this year, updating the feasibility study, and a drill program also to increase our resource at the Louis Hill deposit. Gibellini is fully drilled, fully feasible, and we look forward to update the market on this vanadium project over this year. Thank you very much for coming today.
Paul?
Ladies and gentlemen, Paul Cowley with President and CEO of First Vanadium Corp. And we're focused on the Carlin Vanadium project that's in the Carlin Gold Trend. It's the largest, highest grade primary vanadium deposit in North America. Last year, a little snapshot of our corporate share structure. We've got a tight share structure of 39 million shares. We've got $2 million in cash. We've got warrants that are all in the money that can bring another $2.6 million into our treasury. 2018 was an exceptionally good performance year for us. We started off at about 20 cents, got up as high as $2 rather, and just a pullback in December to our levels around 80 cents. So good buying opportunity, I think. at this level, you can see that we've already started to climb back out of the December dismal markets that everyone has experienced. We had very good trading volumes, 200, 300,000 shares a day. The location of the project, it's hard to beat the location of this project. We're in the Carlin Vanadium, the Carlin Gold Trend, so our neighbors are Barrick and Newmont. We're 6 miles away by road to a major rail hub, to a Newmont mine, to power, and a great milkshake. Great jurisdiction to permit in. Simply put, we're a black shale hosted deposit. It's a thick deposit that's shallow dipping and near surface, about 35 meters thick, about 2 kilometers long, 3/4 of a kilometer wide, fairly predictable there. It's got a historic resource of 28 million tons of 0.52% V2O5, which we will be in next month updating because we've done two drilling campaigns in 2018. There's now 216 holes into it at about 40-meter centers, very detailed drilling. We're anticipating a good resource number next month. Some of the intercepts right from surface up to 73 meters of 0.6%, 48 meters of 1% V2O5. So these are really nice grades. And look forward to putting out our resource to you guys next month. Thank you very much.
And finally, Mark Charlmers.
Yes, I'm CEO of Energy Fuels, and we are a vanadium producer. We're currently producing vanadium. We started up our vanadium circuit that was once owned by Union Carbide late in 2018. Our core business is uranium, but certainly the renewed interest in vanadium. Now the plant has produced a lot of vanadium over the history of the plant, around 45 million pounds. So this is not new to the White Mesa Mill in southern Utah, but we're very well placed. We've got a number of the properties from Union Carbide and the mill, and we're doing a lot of extra new work. We're trying to improve the economics of mining vanadium, because that little chart down there shows the ups and downs, and you can get stung pretty easily. And we're trying to apply new mining grade control techniques with XRFs, and we're having some very good success with that. The company is very well capitalized. We have about $50 million of cash and working capital. We paid down debt this year. We plan to we have some residual debt of about $16 million, a good liquidity, about $4 million to $5 million US a day. So we're very excited about the vanadium space, even though uranium is our primary core focus business, but we're pleased to have vanadium credits that can certainly help us right now. While we're recovering vanadium, the first phase will be just vanadium in our tailings facilities. But we're still, as I said, currently doing test mining conventionally underground. But the first phase is we have about 4 million pounds recoverable vanadium that we're going to produce at about 200,000 to 225,000 pounds per month.
Okay, now on to general questions, and we're going to rotate through. So I know Mark just spoke last, but I'm going to address this to you. We look at the price spikes. There was one in 88 and 89, which lasted less than 2 years. We have a price spike in 1998 that lasted a little bit more than 1 year. 2004, 2006, a price spike less than 2 years. 08, 09, before the global economic crash, 1 year, less than 1 year. And even the price spike we had this year, where the price has gone from $34 a pound to $16 a pound in a matter of months. What's different this time, or is there anything different this time, Mark?
Look, I think these rebar standards in China, and the potential positive impact of vanadium flow batteries are different. The market has always been difficult to capitalize on. I started as a miner in '76 mining vanadium. I was getting 25 cents a pound back then, so this looks pretty good to me. But I think the history's been, particularly with the Colorado Plateau is trying to capture those peaks, and if you're not mining ahead of the peak, you're going to miss it. And that's why I said we're looking at some new technologies of how we're trying to position ourselves. Certainly having a good uranium price underpins some of the risk. So I think the biggest way you can capitalize on the vanadium market on the Colorado Plateau where we are is having a high uranium price to pay probably 60% of the cost for mining and milling.
Well, I tend to agree with that take. Paul, you have a black shale play in Nevada, which to my knowledge is vanadium only, and it has a grade of about, what, 0.5% vanadium. How would you address the price spike? And also, how would you compete with uranium producers in the Uravan district who have grades of 1.5% vanadium?
Certainly, I think things are different this time. I think there's the elements of supply and demand. There's the things that are affecting supply and demand have changed a lot. There's new policies and new laws from an environmental and safety aspect in China principally, but also in the U.S. that are having a big influence. The dirty, expensive mines are getting shut down in China. There's no the ban on scrap metal into China is having a bit of an effect as well, and the additional safety aspects for the rebar is increasing it from the demand side. And I think there's never been before. There's been the buzz of the battery sector. It's been sort of research and development up until now, but now actually we've moved into deployment and commercialization. So that's a new wave that's started. It's a question of how fast it's going to grow, but I think we're into that cycle. And I think there's also vanadium in EV batteries that could also have a big impact on demand going forward. So I think there's a spike. The spike that happened, the severe spike, happened because of very timely law for November 1st on that rebar issue in China. I think that big demand that's caused will still go forward, and so it was just a reactionary thing around that close around that time of November 1st. I see the prices leveling now, and I think are going to continue to grow because those demands are outstripping the supply lines.
So I might mention that exacerbating the situation with vanadium supply was a shutdown of one of the 3 mines in South Africa recently at the same time as this Chinese rebar requirements came about. So you've taken 10% of supply off for various reasons, including electrical costs in South Africa, which exacerbated the situation. Gerald, I'm going to ask you the same question. What's different this time, and how can a company with the Gibellini deposit, which runs about 0.2% vanadium and recovers 60% of that in heap leach, possibly compete in the vanadium market with uranium producers, steel slag, oil and gas residues, and coal fly ash, which are all ramping up given the vanadium price?
Thank you.
I'm a skeptic, as you can tell.
Well, that's okay. You were skeptical at Detour. So, and I prove you wrong. So I don't mind proving people wrong again. It's very simple. First of all, we're not 0.2%, we're 0.29, which is close to 0.3. Our recovery vary between 60 to 70%. We're using 62% as an average conservative recovery. Our cost is currently break-even $6 to $7 a pound. And when you look at the graphic, of course, graphics are spikes. I spent 35 years in gold. I've gone through spikes before, and there's a bottom, but do we build a mine because of the spike, or we build a mine because we know it's economic? Currently, our mine, if you use a $16 a pound price of V2O5, is worth approximately $55. Our operating cost is at $21 per ton, so we're making $34 a ton if we're in production today. This is how you look at the market. The spikes are great. We don't build mine for spikes. We build mine because we know it's a solid project. The reason we can do it with such of a low grade at 0.3% or 0.29 to be more precise, it's because we don't have more than 1% of carbon into our ore body. Carbon is a very tricky component of the black shales, and if you have more than 1%, for example, Union Carbide did a lot of exploration on those deposits in the 50s, and if you have 5 to 10% carbon, you will need a roaster. So try to permit a roaster in Nevada today. And that's why Gibellini is a first-class, first heap leach vanadium deposit, same as copper leach, sulfuric acid, that doesn't require a lot of capital investment, approximately $100 million. And to go back to the graph, like we saw, the implementation of the Chinese government for the rebar industry, we're not going to see the effect for, again, maybe another couple of years. We don't know if they're going to stop exporting vanadium, and maybe they're going to need to import vanadium. We know it's the biggest producer, but we don't know how far this effect on the rebar will be because it just got implemented. So we have to wait a bit of time for that. Thank you, Mikey.
Thank you. Mickey is my name.
Mickey, sorry.
George?
Same question to me?
Yeah.
Well, you know, it's just interesting. It's a commodity, and we all remember the spike in uranium a few years ago when it spiked, and what happened? Production went up, demand went up slowly, but production went up substantially faster than demand. That's what happened to the uranium price. It went back down. That could very well happen to vanadium. If you bring in all the production planned for vanadium, it's going to overwhelm the supply side. So again, what you'd need to do is plan for the low side of this thing. And I'm not an expert by the pricing. There's a lot of people that know more about it. But I went to a Ferro-Ally conference in Orlando, Florida about 3 months ago. Virtually all of the vanadium customers were there. And the speaker there said, we're going to have a low again, but the low isn't going to go to the lows that we've had in the past. So we can plan for a higher low price. And we'll probably not have a 33 constant price, but our high price will be higher than the high prices in the past. So projects that can produce and make money within that new low will probably come into production and stay in production. And of course, that's where we believe our project is.
Thank you very much. Future demand is tied to Chinese steel industry. With the slowdown in the Chinese economy, how can we be confident the Chinese steel industry is still going to be viable? And we'll start with Paul here and work our way back.
China is a big element here in steel. I would have to say just the increase in the requirements of steel into the vanadium is an increase in intensity of the use of vanadium in steel. That's new. They've got to rebuild their infrastructure. There's three cities that are building subways that are requiring 10% of the annual production of vanadium. Those are things that are still going about. And there's big multi-trillion dollar infrastructure projects in Russia and China and even in the U.S. everywhere that have to revamp their infrastructure. There's a little bit of a slowdown, I think, but I think there's still requirements that need to be using vanadium in the future.
Gerald?
Well, I think Paul answered very well. I mean, I think the rebar situation going from 300 gram to 600 gram in China is a big change. I mean, if they were consuming 10,000 ton and now they need to put 20,000 ton of vanadium, that's a big change with the shutdown of all the dirty mines. At the same time, I think infrastructure in the world will keep doing. For anybody who don't know, they use 1,000 gram per ton in the US or in North America for structural steel. So I think there's a good future for vanadium. Yes, of course, there's going to be more mines coming up. There's going to be more development. But at the same time, if you're well positioned in a safe jurisdiction like in Nevada or in the US, like we all are at this table, we have a market for us right here in North America, and we stop depending on importing it.
So I'm going to switch gears here and start with a different question, which is the majority of vanadium comes from steel slag. We also have vanadium coming as a byproduct of uranium mines, especially in the Uravan belt. Oil residues. Exxon announced a plan a couple of months ago to increase its recovery of vanadium from oil refining in the Gulf Coast of the United States. And then we also have recovery of vanadium ongoing from coal-fired power plants. And so those guys see a vanadium price that soars, and they're going to ramp up. You know, the thing about these spikes is, and George pointed out before, production increases. So what's your take on that, George?
Well, obviously that's going to keep the price from skyrocketing, because when these new supply sources come in, you know, it's going to limit the upside. But again, there's a certain cost to these sources. They've got to have a certain price. They can plant it at $16 or $20, but if you go back down to $5, they're going to shut down. That's why there's been spikes in this. Union Carbide was a master at this. They would produce uranium and vanadium, and they would hold the vanadium off the market till there was a spike, and then they would sell it, and they flooded the market, would go back down. And that's how they basically, Carbide probably, I wouldn't say had a monopoly, but they controlled the price by holding vanadium off of the market when price was low and selling into a high market.
Okay. So we mentioned this, how small this market is, or maybe I did not. Gerald referred to it from 10,000 to 20,000 tons with the Chinese possible increase. But the entire market, folks, this is the 17th largest metal produced in the world at 80,000 tons a year. Mark, would you like to address the supply-demand fundamentals of such a small market? Do we expect it to grow exponentially or even double in the next 10 years?
Yeah, look, I'm not an expert on the actual vanadium market itself, but I think I said earlier that our company is first and foremost a uranium company, uranium-focused company. And the way we're going to combat the volatility of prices and these secondary sources that can contribute a large portion of the vanadium, maybe all the vanadium, is to be low cost on the cost curve. And in our case, like our company filed this with Your Energy, filed Section 232, looking for higher uranium prices by underpinning the uranium prices and focusing on doing things a bit different, like we're saying, with new technologies, increasing recovery and whatnot. We got to lower our costs as low as they can be. And George is absolutely right. Union Carbide did not try to time the peaks. They mined vanadium continuously, they inventoried it, and they sold it when the prices were higher. And so this is history repeating itself on how they used to sell the product. But you've got to look at a number of things. The uranium price, particularly in our case on the Colorado Plateau, we got to look at new technologies, we got to look at trying to improve the recoveries and get to the point to where you've got you're a low-cost vanadium producer. You know, the swings in this business, you know, those are pinches. Every time there was a reduction in supply, those pinches created those peaks.
Okay.
And so you know, I mean, as I said, I'm not sure how the whole market unfolds. I think it looks much more positive, as I said, but our approach is going to be focused on uranium as a core business and vanadium as an alternate. And I would love to be producing vanadium continuously, just like Union Carbide did, but at lower prices.
Okay. So let's, with the prices, the battery industry right now comprises about 4% of the market. About 4% is chemicals, and what's that leave? 92% is used in the steel industry. Gerald, would you like to address the battery component and how that, if prices were to remain high, how does that impact the economics of vanadium, large array vanadium, large scale vanadium batteries?
I'm going to try. It's been around for 20 years, the VRB, and they're making progress. They use a lot of land. They will use a lot of vanadium. They'll put it in a liquid form. It's the best way for renewable energy to store energy. It's likely the future because, as we all know, we cannot store energy. We have failed to store energy for long-term purpose. Vanadium is the best element they found so far to conserve and store energy over a period of 20-25 years without losing anything. I think the market will become amazing the moment we can condense those batteries and be able to sell them on every residential person who wants to get rid of their generator and put a long-term storage battery on your 12,000 acres farm.
120,000.
120,000. I think for me, the battery sector is still in development. I don't think we're going to see the answer next week, but I think we made a lot of progress on energy storage, and I think vanadium has got a good future for that, but it's not going to happen tomorrow morning. But the moment we sell those batteries to everybody who needs one, it's going to be very different.
Okay, yeah, if we got any questions from the audience, we can take a couple of questions.
I was curious what the overall vanadium pentoxide production cost is per pound and what the plans are to produce vanadium electrolyte for vanadium batteries in the future for each panelist.
At our project, Gibellini, which could be in production 3 years from now, currently we estimate that the cost per pound of pentoxide will be $7, all inclusive of capital sustained development, and as an operating cost, approximately less than $5 a pound.
Okay, thanks for coming, folks. Hope you learned something.